Is the ECB coming to save us all? That is the question that we ask ourselves on another difficult day for financial markets. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we are going to focus our attention at Brussels today, as well as at Frankfurt, because whatever seems to be going on in U.S. markets doesn't look particularly hopeful. Obviously, strong losses here across Wall Street, and perhaps there is a bit of a respite coming from across the Atlantic. The ECB due to announce monetary policy today. As ever, if you're watching this on YouTube, jump into the comments and share your thoughts, and we'll incorporate them into the show going forward. So as we start to consider what this might be, what we're going to do first and foremost is establish what the expectations are, establish what the ECB might do and why, and then consider what the response from markets might be and why this might be an important inflection point, not just for Europe and not just for the euro, but also for Wall Street, for stocks more generally, and of course for the US dollar. So let's begin with some stage setting. There is virtually no chance that the market sees that the ECB is going to raise rates here. None. If we look out through the rest of the year, we have one more meeting left in December here. The probability for a rate hike is a big 8.1%, meaning there is a more than 90% chance that we are not going to get further tightening. The likelihood of a increase in January, 2.5%. Between now and January, a cumulative 9%, all of which is to say the market thinks the ECB is done here. The first cuts looked almost certain by June, 95% chance of a cut by then, already fully baked in by the time we get to July. In fact, if we take a look at the broader picture here, we can see the implied policy curve for the ECB has shifted meaningfully lower since the ECB last met in mid-September, signaling that where before the market was contemplating the possibility that rates could rise from the current 4% deposit rate, that's the big dotted line you see there, now there is standstill at the 4% basically for the next 6 months, then cuts, 50 basis points already there, as we can see, 1 year out, 3.49 there. And by the time we get to 2 years out, we're down to 3% where we stabilize. That's a much more dovish view than what was there when the ECB last met, and it's not surprising why. We just got the latest PMI numbers this week telling us that we're shrinking for yet another month on Eurozone growth. In fact, the pace of contraction is the fastest it has been since November of 2020. So right in the very wake of COVID lockdowns and still very much in the place where the pandemic was ravaging economies all across the world. So not exactly a very encouraging assessment of Eurozone growth. This is the fourth consecutive month of contraction, reinforcing the idea that GDP in the region almost certainly shrank in the third quarter, and the area is almost certainly in recession already. As ever, this is the PMI view of things. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. And so you can see here, these indices are, first of all, below 50, which means that manufacturing, services, and the two together are all pointing to shrinking economic activity. And they're going lower over time, which means that the pace of contraction is actually increasing. Against this very dire backdrop for economic growth, we also have, to add insult to injury, credit stress. In fact, what you see here is the extension of what the Fed is doing by holding rates, quote unquote, higher for longer, show up in the Eurozone. And of course it is. So what you see in the dark blue line there is the Eurozone Financial Conditions Index. As it goes down, we can see that the situation is getting increasingly more restrictive. In fact, that index now approaching the zero line, so approaching an area where we're looking at contraction. And we have a situation where in parallel, the financial stress index, which is a measure of turmoil and uncertainty in the credit markets from the Office of Financial Research, that's at the U.S. Treasury Department, that's rising. So clearly, overall stress since September's FOMC has increased in credit markets, and that has not left the euro area unscathed. Credit is scarcer, stress is higher. Now, we can see why that's occurring. When the Fed made this announcement, what we see here is, on the one hand, no more rate hikes. So the 2-year yield, the front end of the curve, is stagnating, but higher for longer. So the long end of the curve is rising. So in an environment where the Eurozone, as we just saw, is almost certainly in recession, China can't get off the mat, and growth in the U.S. stands in between a coordinated global downturn and where the markets currently are sitting, a Fed that wants to keep borrowing costs higher and degrade that line of defense for the global economy, not surprisingly, injects uncertainty and stress into the markets. And so what we see is a rise in long-term borrowing costs, largely thanks to expansion of term premium, which is the excess return, the additional return that markets demand for lending over a longer period of time. Why would the markets demand a higher return for lending over a longer period of time? Because more can go wrong in that extra time. So in perceiving greater uncertainty after the Fed says last month, we're going to hold rates higher at this particular juncture in the business cycle, you get stress in the bond market. Credit starts to crimp as a consequence. And we see that spill over in the euro area. Now, why should this spill over in the euro area? For the very familiar reason that the dollar is the quintessential unit of commercial exchange, and nothing else comes even remotely close. So when the Fed increases the cost of borrowing dollars, it increases the cost of capital for everything and everyone, with the possible exception of an economy completely disconnected from the global financial system, like something akin to North Korea. So that aside, of course, the Fed's actions and their influence on bond markets has spilled over into the euro area. In fact, it gets a little bit worse here. Not only does this action from the Fed give us a pickup in financial stress, that's the red line there, and also a dip into restrictive monetary conditions, that's the same index there, that same financial conditions index slipping under zero, much as we just saw it on the previous slide right here. So we can see the stress index now above zero. That's right there. And here we go. And the financial conditions index now in negative territory. So actually, restrictive relative to average. So, not only are all those things occurring, but sovereign risk seems to be rising as this stress in bond markets builds. So we can see that the spread between Italian and German government bond yields is once again widening and is at this point at the widest it has been in close to a year. Now, what does that mean? Germany is a kind of benchmark for fiscal rectitude in the Eurozone. They don't have a lot of debt. They're the sort of gold standard of high-quality Eurozone borrower. Italy, on the other hand, is notoriously addled with debt, both public and private, and so is very sensitive to rising borrowing costs and general turmoil in the bond market, because that immediately starts to raise questions about the possibility that they might not be able to finance that giant debt burden. And so what you see when there is extra credit stress, when credit markets see rising rates around uncertainty, is there is a fear that something like Italy will have a harder time in that environment paying down its debts than something like Germany, which doesn't have nearly as many of them. And so that additional compensation that people need for the added risk in Italy as relative to Germany manifests itself as the widening of the yield spread between the two. Much like you might say a widening of the yield spread between the kind of interest rate that a debt encumbered student might experience as relative to somebody gainfully employed in a high-paying job for the past 10 years. If things are quiet, those two people can probably have a more comparable time borrowing money than if the market is mindful of credit risks, as it were, and lenders are more reluctant to lend to riskier borrowers and demand higher compensation if they're going to do so. So we're in a situation in the Eurozone where there is recession almost certainly already underway, and monetary policy is making it worse, both domestically and as spilling out from what the Federal Reserve is doing. At the same time as all of this is occurring, inflation is actually down quite a bit. The latest reading here, 4.3%. That's clearly the lowest it's been in over 2 years at this point. And on top of that, most of it is still food inflation, which is that pink area there. In fact, if we take a look at the contributions to Eurozone inflation just in this latest September report, interestingly, we can see energy is actually still a negative contributor for all of the conversation about Europe's vulnerability to gas disruption in Ukraine and this and that. Inflation is actually being pulled lower by energy, not higher. But the biggest component here is food. 1.5 percentage points of the 4.3% rise in September accounted for by food. If we strip that out, we're left with just 2.8% for inflation, which is a comfortable glide path given the very dire economic conditions in the euro area toward inflation at 2% over a 1 to 2 year window that the ECB has in mind. Now, why would we factor out food? Well, there's not much that the ECB can do about food. So setting policy on the basis of food costs seems not like something that should overpower the need to at least somewhat offset spillovers from a higher for longer Fed and a recessionary economy. There's not much that the ECB can do to mandate food prices down. Indeed, with the economy slowing, that ought to happen by itself. And so there is seemingly little reason for the ECB to really want to press the inflation point at this stage. There's not a whole lot that they can really do. Meanwhile, the argument for, at the very least, stopping rate hikes starts looking more compelling given everything else that's going on. With that in mind, we consider that the market's expectations for conditions in the Eurozone since about mid-year have shown themselves to be worse than even the dire reality on the ground. Now, we know that markets are creatures that are forward-looking. Investors don't so much move on things being good or bad, they move on things being worse or better than expected. This is what creates volatility in financial markets. Financial markets embed in them a set of expectations because, of course, nobody can tell the future. So there is a baseline expectation embedded in the price of any given asset that the factors impacting it will develop in a particular way. In this case, it seems like the modeling that was embedded into benchmarking what the Eurozone economy is going to do was more gloomy than reality has endorsed, even though the reality has been, as we've just seen, sobering to say the least. We can see that from about the middle of this year, according to data from Citigroup here, Eurozone economic data has improved relative to forecasts, even as it still tends to broadly undershoot those forecasts. The margin for difference here has clearly narrowed. And a lot of that has come from expectations for what's going on in the Eurozone being pulled down, with consensus forecasts on how the regional economy is going to perform having been significantly lowered. Not surprising, of course, with all the issues that are at work here in the Eurozone, not to mention a hot war just around the corner, impacting Central Europe and a little bit further east. But nevertheless, because markets are creatures that are forward-looking, what matters here isn't that absolute, but rather the relative. That although things have been bad and are bad, they are not worse. In fact, they are marginally better than it was feared. And so from this perspective, an ECB move to come out and say, we feel we're done raising rates, is a powerful signal that perhaps the worst is indeed over and bargain hunting can ensue. That the ECB will go this way was almost announced ahead of time. The ECB doesn't seem to have the kind of blackout period that the Fed does, where before a policy announcement, the Fed doesn't say anything at all, just to make sure that the markets don't over-extrapolate some comment to be telegraphing what the policy decision is going to look like before it actually occurs. The ECB does not feel so encumbered. As a matter of fact, just over the past day, speaking to Greece's Antenna TV, ECB President Christine Lagarde said, well, we need to look at the risks and where they are, but I'm confident that we are on a journey to bring inflation back to 2%, which is to say, we've done enough to raise rates. We are on the path now. We can just sit back and continue to let this go. If we get that kind of signaling out of an ECB at a time when perhaps the worst is over, at least in relative terms, the question of bargain hunting, not surprisingly, emerges. Now, we can see U.S. financial markets, where higher for longer is very much an unadulterated risk still. Markets are up double digits still for the year, up close to 10% for the benchmark S&P 500. That compares to a 2% decline since the beginning of the year for Eurozone shares, about an equivalent decline for UK shares, a slightly more modest decline for EAFE, which is a broader excluding US sort of index that includes Europe and includes the buoyant parts of Asia and Africa as well. So a kind of excluding North America view. And of course, emerging markets are down even more. Not surprisingly, much of that space is made up of vendors to the three major economies that are driving economic growth, the US, the Eurozone, and China. Clearly much slower demand for all three. And of course, China swims in both oceans, as it were. It is reliant on the US and the Eurozone and is a vendor to those economies, and so contributes to this EM turmoil. If the Eurozone gets a central bank ready with a lifeline, however, all of a sudden, the situation looks a little bit more attractive. So you may be looking at a situation where the worst on the economic data front is over, and the central bank is done complicating the situation by keeping borrowing costs rising. In this case, it seems like the ECB is prepared to say, we're done with all of that. Now the question is how long we're going to hold before we cut. All of which might inspire bargain hunting investors to say, well, there might not be much to do in US markets at the moment, but if the ECB is going to create better lending conditions, at least in euro-denominated terms, by pushing back and starting an easing cycle next year, well, maybe risky assets in euro-denominated terms are now on discount, given how they've performed so far this year. And so there is perhaps a case for some rotation, where US markets do less well, European markets do better, at least in the near term. Now, what's interesting there is you might actually see the euro perform better against the US dollar, even as the ECB strikes a more dovish tone. Not because the conversation would be focused on yield differentials, but rather on where capital flows are going, because risk appetite has decided that this rotation makes sense. And so if we get this ECB announcement whereby we get this dovish shift from policymakers, and at the same time the euro manages to rally with European shares, the story may well be that risk appetite has found something of a bottom, that stocks have found a reason to anchor around recent lows, and that a rotation out of US markets, at least on a temporary basis, to close some of this performance gap starts to come around, at least until the Fed itself comes around to the idea that it also is ready to consider publicly a rate cut cycle. In the meantime, there might be a bit of a geographic reshuffling for where risk sentiment goes and which assets do well into the end of the year. Perhaps a reshuffling that favors one kind of global equity over another, so non-US over US, even as overall markets find a floor. And the biggest release valve might well be the US dollar, which comes down in this scenario against most of its major counterparts. And that is macro money for today. As ever, we are here every Monday through Thursday right after overtime. a show that I co-host with Chris Vecchio and increasingly Dylan Radigan. I'm on with Chris again for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. As ever, if you're watching this on YouTube, do jump in the comments and let me know your thoughts. We'll incorporate them into the show. Good luck out there. We'll be back tomorrow. Take care.